So this would be our discussion for cash flow analysis, which is part of your modules for prelims in management accounting and control. In here, we will be discussing about the significance of cash flows for the analysis of an organization, and we'll have some problems, a problem to discuss or to solve regarding cash flows. So why do we do cash flow analysis? First is we need to have an outlook of the cash flows that we expect to have in the organization, specifically those that comes from operations, because when we earn, like the company is earning, it is not sufficient that there are only revenues or profits that come in the organization, because unless those profits or revenues are converted into cash, they cannot be used or utilized by the organization to further the operations, because as we know, cash is the most liquid part of our assets, and primarily we transact we transact with suppliers or with the sources of our supplies, uh, and also inventories and other obligations relating to the operations of the organization through cash. We cannot pay using other methods, like maybe if we do service to them, that might suffice, but primarily we fulfill our obligations with suppliers and vendors using cash. That's why we need to know whether we are sufficiently generating cash. Also, moving forward with the operations of the organization on whether to expand or to cut off a bit on spending is determining whether there is sufficient cash flow in the organization to keep up with this expansion, or do we need to step back a little bit. So we are able to identify such using our cash flow analysis. So it is not sufficient, again, that the company is earning. We also need to determine whether the earnings that we have are converted into cash so that they can be put to use in the operations of the organization. Next is we need to determine the ability to pay dividends to shareholders and interest and principal to creditors, because primary concern of our shareholders and creditors is that we will be, for the shareholders, if we will be able to finance, to give back a portion of their investment in the form of dividends. So they are concerned on whether they can earn. And then for the creditors, they are concerned on whether we will be able to pay back the obligation that we have for them. So the key here is when we have cash from operations, when we generate cash from operations, then these people, the shareholders and the creditors, would be more confident that we will be meeting the obligations that we have to them. Next is to show the relationship of net income to changes in the business's cash, because again, it is not sufficient only that the company is generating income. Whether your company is profitable, if it does not generate this profits into cash, it's hard for them to liquidate. Then there is an issue regarding the maintenance of the company's operations, because if they stay on the receivable side, then it is difficult for us to continue operations. So for the statement of cash flows, this depicts the sources of cash of an organization on whether they come from operating, investing, and financing activities of the entity. So I believe we have already discussed this in one of your subjects earlier this school year, but still we will be having some brush through on it. So this is designed to provide information about the changes in entities' cash and cash equivalents. One of the most important assets of the organization, of any organization in that matter, is maintaining a sufficient amount of cash and cash equivalents in such a way that it is not too plenty, that we are keeping cash that does not help the organization, or it is not too low in such a way that we might disappoint our creditors and those in which we have currently maturing obligations. So it should have a perfect balance, not too high or not too low. Now, for cash flow computation, bank overdrafts that are repayable on demand are included as part of cash and cash equivalents. So when we have a negative balance for cash and cash equivalents, it's still included as part of cash and cash equivalents for here. So the classification here is we have operating activities, investing activities, and financing activities. What is the difference of computing operating activities, cash flow from operating activities using direct or indirect method? When we use direct method for computation of operating cash flow from operating activities, we start with cash inflows from revenues, sales. While using indirect method, we use the net income, and then we adjust net income with the non-cash expenditures that are deducted, and then we will analyze the change in current assets and current liabilities so that we will get the income from operating activities. Now, classification of cash flow activities. Operating, this is the principal revenue producing activities of the entity. So generally, these are cash flows from purchases or sale directed towards the primary purpose of the entity. So in here, the accounts that are usually affected are current assets and current liabilities. So if we will analyze that further, those are part of the working capital. While cash advances and loans made by a financial institution are usually classified as operating. So the operating activities actually depend on the operations of the organization. Like interest, revenue, and expenses, those are classified as operating activities for banks and financial institutions. Investing activities, these are usually the assets that are affected here are the non-current assets, because these are acquisition and disposal of long-term assets and other investments. For financing activities, the items that are affected here are non-current liabilities and shareholders' equity, because this would be the borrowings and equity, sources of financing, sources of funding by the entity. And also we have what we call non-cash activities. These are items that affect the statement of financial position and statement of comprehensive income that does not involve cash. What are the examples of this? For example, we purchase an equipment in exchange for services that we render. Then those are non-cash activities. What else? If we engage a lawyer or a professional in exchange of in exchange of shares of stocks of the organization. So generally, the engagement of a lawyer or a professional would be a cash outlay on operating activities, and then it would be the issuance of shares of stock would be cash inflow for financing activities. But since there is no cash involved, we generally exclude them in the cash flow statement preparation. After all, if we will include them, they would have an offsetting effect. But then again, they should not be included in the analysis because they did not involve any cash. So for the preparation of statement of cash flows, we have items that have alternative treatments, or we present them differently. For example, interest. In general, we consider interest as operating cash inflows or outflows, whichever applies. Because, after all, why do we primarily consider them as operating cash flows? They pertain to funds that we acquire. Yes, indeed, they are financing in nature, or when they are receivable, we invest upon. But then again, we use or source out this cash as a result of our operations. After all, we borrow money for operations, or we shell out first that money as so that it will earn interest because it is temporarily set aside for operating purposes. Alternatively, interest expense is classified as financing cash flows because whatever the primary source of that interest is, that should be the classification of the interest. Alternatively, for interest received, it should be classified as investing activities. So depending on the source of the interest. So if it is interest payable, then it is financing, and then if it is interest receivable, it is investing activity. But primarily, remember, primarily, meaning the primary treatment is they are classified as operating cash inflows. How about dividends? So dividends come from dividends that we pay are a result of our financing. So primarily, when we receive dividends, we classify them as operating cash inflows. After all, it is a source of revenue. There we go. But alternatively, if we have an investment and then that investment received dividends, it will be classified as investing cash inflows. Alternatively, how about income taxes? Generally, we consider income taxes as operating cash inflows or outflows. That is because we pay taxes. However, if we can specifically identify the source of tax, whether it is investing or financing, then we should classify them there. So it is a general treatment unless there is a specific identification.